My question is, as we head into 2026, does this underperformance make crypto look like it could potentially be a value asset next year, or is it potentially a harbinger of more pain to come?
I'm going to make my shot at the maxis. Stop attacking ETH. Continue to attack JP Morgan and the Fed. There's your enemy, the JP Morgan, the Fed, not ETH. If you want to continue to fight ETH, you're holding yourself back because you need ETH. ETH needs you. You don't need JP Morgan. You don't need the Federal Reserve. I actually did interview to be a Fed governor back in May of 2019. If I had gotten that job, I would be basically chaining myself to the door of the boardroom saying no one is allowed in if they want to cut rates. Larry Fink and Jamie Dimon are going to saddle up to you, make you nice, make you feel comfortable, give you a back rub. And then when the time comes, they're going to rip the heart out of your chest and they're going to take it all away from you and leave you with nothing. Do not trust them. That's why I said I'd rather you trusted ETH than if you trusted those guys. They're not in it to help you make a better system to put them out of business. They're in it to control you.
Bitcoin 1 year from now, December 3rd, 2026, where do you think we could be? Based on all available information, your view of how things could play out.
I think we got to go below 74K first, maybe down, under...
Good morning, afternoon, or evening, and welcome back to another episode of the Coin Bureau podcast. Now, on our show today is a guest, Jim Bianco. He is the president and founder of Bianco Research, one of the most well-known macro analysts in the space with his very spicy crypto takes. So, Jim, a very warm welcome to the Coin Bureau.
Thank you. Looking forward to the conversation.
Great. We'll dive right in, Jim, but just a few quick disclaimers for the audience. Nothing in this video is financial or investment advice. Please consult the disclaimer in the description for more information and consult your financial advisor before making investment decisions. Now, Jim, I want to start with what's going on in the crypto markets, because in case you haven't checked the markets recently, it's not looking too good, although it's a little bit up today. And you warned earlier this year in a Twitter post that if by year end, major cryptocurrencies such as Bitcoin and Ethereum end up underwater, the crypto sector will end up as the worst asset class in 2025 in terms of performance. Right now, Bitcoin's close to flat for the year. My question is, as we head into 2026, does this underperformance make crypto look like it could potentially be a value asset next year, or is it potentially a harbinger of more pain to come?
Well, I guess the answer is it depends on who you think the crypto buyer is and what is their motivation. 24 was a fantastic year. In the second half of 23, and the battle cry was adoption. Here come the boomers. We're going to give them these new tools like the spot ETFs to purchase so they could stay in their native environment, which is their regulated brokerage account. And we've also got the OG treasury or Bitcoin treasury in MicroStrategies, which is now Strategy. And those were the big powers that pushed the market up through about the middle of 2025. Now the market is correcting. And as you pointed out, we're recording in early December. The year-to-date return is about zero, roughly speaking. But keep in mind that all of the alternatives are up huge. If you didn't buy crypto, what would you have done with your money? You might have bought gold up 50%. You might have bought silver up 70%. You might have bought AI stocks or triple Qs up anywhere between 20 to 50%, depending on what you're talking about. So this is not like 2022. 2022, crypto corrected 30 or 40%, but the stock market, the S&P was down 25. Everything else was down. So your argument was, I lost money in crypto, but what could I have done? Because everything else is also down. And that's 2022. In 2025, the answer is, I lost money in crypto. I could have thrown a dart and made more money anywhere else. And that, I fear, might sour people going into 26 about buying crypto. Because the idea is, with the adoption is, you got to own some of this because it's going to go up. The lesson taken away from this year was, own anything else but crypto. And you would have made money. And so I don't know why people are going to say, yeah, right, I missed 50% in gold. I missed 70% in silver. I should have bought Palantir's up 240%. But man, I want more of that thing that lost me money in 25. I just don't think there's a big audience for that. And that's the fear that you're going to have to go through in 26.
Yeah, that's a fair point. One of crypto's best marketing devices is the price and the performance. Why do you think, so then it pointed out all these other asset classes that have performed very well this year. Why do do you think crypto has this idiosyncratic performance in terms of like not the market performance? Why has it's underperformed itself as an asset class so much?
Well, I will say, first of all, at the top, it's not all bad, because the complaint about crypto has always been that it's just a highly levered triple Q. Triple Q is the NASDAQ 100 ETF, and that it goes up and down with the speculative investments in the TradFi world. Well, it's not doing that. So if it's going to break that correlation for a longer period of time, that would actually serve it very well in the long run. But I do think that part of the problem is, I'll go back to that adoption word because it's a loaded word. When I got into the crypto space, 2016, 2017, I was all excited about it as the idea that it was going to be an alternate financial system, that we were going to create DeFi, we were going to create store of value with Bitcoin, we were going to create stable coins, which we did back, around that period. And it was going to be something to do other than your regulated brokerage account. It was going to be like Uber was to taxis or Airbnb was to hotels. And what happened with this whole adoption movement starting around 2023 was, it was almost as if Uber was bought by Yellow in the early stages. Or, the famous story that Blockbuster turned down $50 million to buy Netflix, and then Netflix went on to dominate the world. I was always uncomfortable. I know a lot of people think of me as a crypto bear. I'm really not. I'm actually very long-term bullish on this stuff. But what I am concerned about was, I wanted to see this space take more of a Travis Kalanick type of approach. Travis Kalanick is the founder of Uber. When he asked if he was ever going to sell Uber to the taxi companies, he said, no, I'm going to destroy the taxi companies. I'm going to take them over and I'm going to be the taxi companies. All of this excitement around the Genius Act and the Clarity Act and everything else, and we're going to saddle up, and our best friend is going to be JP Morgan and the Federal Reserve and the European Central Bank. You've lost your focus. You want to drive them out of business. You want to be a better version of them, not bending the knee to get that regulatory approval for this adoption. Because now I'm afraid that the innovation that crypto has been moving along is going to stall. We're just all going to play the game of waiting for the boomers and number go up. And we don't need to really waste our time, trying to build out better protocols or trying to build out better ideas or anything like that. And that's where I think we finally started to hit this road. And now crypto is going to have to maybe start rethinking. It does this every winter. It's going to have to start rethinking what it is and what it wants to do. And every subsequent summer comes along because it starts getting back to its basics of building a better version of a financial system.
Yeah, this is a point you've made quite a few times this year as well, specifically as it relates to the institutionalization of crypto and Bitcoin. For example, the ETFs and all of that. I'm curious, so then if it's becoming part of the system, the financial system it was created to challenge, what exactly defines being in the system? Is it like the regulation component that you take issue with? Is it the Wall Street ownership, or is it custodianship, or something else that you think defines that becoming part of the system?
The hallmark of crypto is it is decentralized and it's permissionless. No one can take it away from me. No one can alter the rules unless you have an improvement proposal and everybody agrees to do it. And that is something that I think when it comes to financial services, the world needs. The world definitely needs that. The majority of the world lives in a space of unstable currencies and not sound financial systems, banks. I'm talking about Southern Asia, Latin America, Africa, the Middle East, where the majority of the people on the planet live. And they could use something like a permissionless, decentralized system where their government can't take their money away from them, they can't permission them, and the like. And what I'm afraid of is, as we're moving forward with the Genius Act and everything else, and is that we're getting closer and closer to permissionless or to permissioned and centralizing a lot of this stuff. Very uncomfortable with like the language coming out of Circle about that there's going to be blacklisting of certain accounts that own USDC and the like. You're missing the focus of what it is. Now, let me put it in a different way. The majority of the world needs crypto. It needs DeFi. And this is a way that I like to explain it. Who doesn't need it? Who's at the top of the pyramid? Top of the pyramid, I jokingly call the Greenwich, Connecticut Country Club. That they're all very wealthy. They all have a lot of money with wealth advisors, that big regulated firms. They don't need it. but they're a very small majority of the world. And who needs it again is, like I said, from Southern Asia all the way through the Middle East. That's what we need. And what I'm afraid of is by centralizing it is we're never going to give those people that opportunity to have the instruments that they need and want, because their governments will eventually centralize it. And what have we accomplished at the end of the day? So I'd like to see crypto get back to more of its libertarian maverick roots, because that's what every disruption has with it, is that libertarian macro roots, and not celebrate that a bunch of people in Washington have said that you're okay, we'll sign a bill and give you rules to the road. They should be setting the rules to the road, not asking for permission.
Kind of aligned with you on the ideological slant there, but curious in terms of as it relates to this price performance itself specifically. What do you think has been the biggest drag in the past? Because Bitcoin did break through its all-time highs in October at 126K. And up until that point, many were surprised by the performance, right? If you'd go back to the beginning of the year, and they had some very big price predictions for December. And then obviously we crashed in October on 10.10. What do you think have been the biggest drivers of this lax price action and suppression?
Going back to May, the thing that really I found very curious is we broke 100K, and everybody talked about the big round number was broken. It was major headlines around the world. Big round numbers are supposed to attract a lot of money, and it's going to be, a slingshot or straight to 150K, if not higher. And it never was. And the flows never really materialized after 100K. Now, to be fair, we went to 120, then we pulled back, then we went to 122, and then we pulled back, and then we went to 126, and then we traded right back down to 80. What I think happened was twofold things, is that crypto market got so big that the marginal dollars needed to push it higher just weren't there for the moment. So you weren't seeing that ever increasing movement in flows. Yeah, we did make new records, but we should be making new records by 2x. In other words, to continue to push and continuing to push prices higher. And part of the reason that you didn't see those flows might be what I talked about earlier. People looked around and said, yeah, crypto is interesting, but so is everything else. Everything else is doing well too. The only mistake I could make in 2025, at least for the majority of the year, was not to be invested. Just pick something other than cash and maybe bonds, but pick something that's a little bit more in the risky spectrum, and it went up. And so that kind of took the call off it. Also, I think the other thing was, if you look at a lot of things around the signing of the Genius Act was, I would say, was like the internal peak of the market. So there was almost like the old adage of buy the rumor, sell the news. Buy the rumor that, we're going to get the adoption because we're going to get the regulatory clarity with the Genius Act. And then once we got it, you kind of got the sell the news type of correction with it. And that's what we've seen. That's my best guess as to where it's going to go. But I would say in real time throughout the summer and into the fall, I kept looking at crypto and going, man, it's not doing anything. It's 110 plus or minus $10,000 for months and months and months. Yeah, it does sneak out a new high by a couple $1,000s, but can never hold it. And that was kind of the yellow flag to me that something was not right, especially after we broke 100,000 and it didn't attract a lot of, money coming in.
I want to get on to next year potentially, because there's a lot of people pinning their hopes on, liquidity and all that, but that's a whole other kettle of fish. But just before we dive into that, because you obviously know a lot, you talk a lot about that, I want to just touch base on the talk of the town right now, on at least on Bitcoin side, is the digital asset treasury companies, which have been unraveling as of late. And although more recently Strategy came out and announced this cash reserve they're going to have for dividends, which quelled a lot of the fears there was that they could potentially sell. But you came out with a tweet a few days ago basically saying that the Strategy's NAV to market value was the lowest it had been since the SVB crisis. So what is your view on what's happening with Strategy right now, and how do you see it playing out?
So all of these treasury companies that we're talking about, and Strategy is far and away the largest. Their business model all relies on leverage. They're borrowing in the bond market and then they're buying Bitcoin or ETH or whatever kind of treasury company we're talking about. Leverage is a two-edged sword. When the market loves leverage, when the market thinks it's a good idea, then the market cap, I'll use Strategy as my example. The market cap of Strategy, the total value of the stock Strategy, is worth considerably more than the underlying Bitcoin that it holds. And by November of 2024, it was trading at 230% of the underlying Bitcoin that it held. So more than twice the level of the underlying Bitcoin. When the market decides that leverage is not a good idea, it punishes these companies. And that's why you're seeing the unraveling. Is with the downturn, it's deciding that levering yourself into crypto or levering yourself into Bitcoin is not good, and it's punishing it. And what's happened is the total value, market cap value, the value of strategy stock is now worth less than the value of the Bitcoin that it owns. And as a matter of fact, some people have even suggested the idea, I mean, it makes economic sense, that strategy should sell some of its Bitcoin and use those proceeds to buy the stock. The stock is cheaper than the actual underlying Bitcoin. So what I see happening in the market, and by the way, that whole NAV thing, I mean, a lot of people push back on it. It's only a sentiment indicator. That's all it is. There is no optimal level of market cap to the underlying Bitcoin or enterprise value to underlying Bitcoin. There is no magic number. When it goes higher, people are bullish. When it goes lower, people are bearish. And right now, being the lowest it's been in 2 years, they're very pessimistic about the Bitcoin because they're punishing the levered players. Now, before you go all contrary, well, they all hate it, so it must be a buy. Eventually it will be. But right now, when you're in the throes of the pessimism, there's the old adage, don't catch the falling knife. And the knife is falling right now. And you want to be very careful to rush in just because everybody hates it. They'll hate it at the low, but that doesn't mean that when they initially hate it, that is the low.
Yeah, I believe that your strategy CEO and Saylor themselves have for the first time even broached the idea potentially of selling some Bitcoin to buy back shares. And that did help lift the share price a little bit and pick up the MNAV ratio. But then again, if it's still very much tied to the price of Bitcoin in aggregate, Bitcoin doesn't pick up in price. That's a risk, I suppose. What about your thoughts about some of the other marginal debts? Because I think that while strategy is it's in the strongest position compared to a lot of the others, do you think that this could be a drag on the price of Bitcoin into the new year?
Yeah, I think it can. Because all of these companies, like I said, the market is souring on the business strategy of leverage. And that's why I think you're seeing a lot of these companies being turned down. Now, what's going to be interesting is just in the couple of days before we recorded this, we've gotten some news that, Vanguard is allowing Bitcoin to be purchased on its platform. B of A is going to allow their wealth managers to add up to 4% of Bitcoin into their strategies for their customers. The price of Bitcoin has rebounded about 6 or 7%. I think probably on that news, but we'll have to see if there's any follow through, because think of yourself as a B of A wealth manager. Hey, good news. You get to buy the worst asset you could have bought in 2025, starting right now. So how many of you people want to rush your clients into this falling knife? And I don't think there's going to be a lot right away, and so maybe that hope that, here come all the Vanguardians and here come all the B of A wealth managers. We'll see if they're ready to sell their Palantir and put people into iBit and call their customer and go, guess what I did for you? And see if their customers think that this is a good idea right now. But short of that, I think that the struggle is going to be, to try and get a new narrative for Bitcoin that is bullish enough to attract new money. I think that new narrative has to be around development and that it is more than just a store of value. Maybe DeFi. We've been talking about, Bitcoin DeFi since Taproot. Hopefully it starts to come into place. This is my other hope too. Maybe the maxis and Bitcoin. I'm going to make my shot at the maxis because I stop attacking ETH. Continue to attack JP Morgan and the Fed. There's your enemy, the JP Morgan, the Fed, not ETH. If you want to continue to fight ETH, you're holding yourself back because you need ETH. ETH needs you. You don't need JP Morgan. You don't need the Federal Reserve. But yet you seem to want JP Morgan, the Federal Reserve, because you want the Clarity Act and all that other stuff, but you don't want ETH. If you get together with them and say, we're going to get together, we're going to talk about DeFi development, we're going to talk about building a new financial system, that could be the narrative for the next summer. Not that we're going to find some more boomers to put 5% of their money into Bitcoin.
Yeah, that's a very good point that the Bitcoin maxis are aligning with bank whose CEO has called Bitcoin a scam and anyone who buys Bitcoin stupid. And it's just crazy how the tables have turned.
Let me put it to you this way. I'll be very blunt. Larry Fink and Jamie Dimon are going to saddle up to you, make you nice, make you feel comfortable, give you a back rub. And then when the time comes, they're going to rip the heart out of your chest and they're going to take it all away from you and leave you with nothing. Do not trust them. And I'm not saying them in specific personalities. The TradFi system sees you as a big piggy bank and they're a hammer. They're going to smash it and take all your money. Don't trust them. That's why I said I'd rather you trusted ETH than if you trusted those guys. They're not in it to help you make a better system to put them out of business. They're in it to control you, to centralize you, to permission you, so you cannot take it away from them. That's why I've never understood the excitement around the Clarity Act and the Genius Act. I'll repeat myself, like Kalanick. I don't want to partner with them. I want to drive them out of business. And that was the early days of Bitcoin, which is when I got interested in it.
Yeah, it's kind of being co-opted these days. Another thing that Bitcoiners and crypto holders in general are looking forward to, or as their last hope, potentially last chance saloon for the altcoin season or the Bitcoin bull market top out at 150, 200K, all this kind of stuff. The one thing they're holding out for is this concept of liquidity is going to flow into the market. We could potentially see the liquidity come in Q1 because of all these things like the banking reserve ratio and a new Fed governor, rate cuts, and all this kind of stuff. From reading your post, you don't seem too convinced by that. So firstly, I just want to get your perspective on the concept of increased liquidity next year on a macro perspective, and then also what could that potentially mean or not mean for crypto as an asset class.
So the liquidity story is an interesting one. You're right. We're recording in early December, and December 1st, quantitative tightening ended. So, after 3 years of the Fed reducing their balance sheet, they've ended it. They're going to cut rates at the December meeting. Whether or not they cut rates at the January meeting remains to be seen. So it appears that there's more liquidity coming. And you're hearing people, even in the crypto community, yelling, here comes QE, here comes zero interest rates, here comes money printing, and that's going to push the price of Bitcoin to the moon. There's a big, giant caveat to this. In 2010 to 2022, we did all that. Zero interest rates, money printing, pumping liquidity, and it pumped up everything because we could get away with it. And what is the definition of getting away with it? There was no inflation. No matter what we did in terms of printing money, whether or not Europe went to negative interest rates, whether or not we in the United States went to zero, couldn't get the inflation rate to go up, just could not get the inflation rate to move. And in that kind of environment, you could throw money out the window. And yeah, that would be bullish for crypto if you did that. But this is 2025, about to become 2026. We're 5 years past COVID. We can't get the core inflation rate under 3%. That is too high an inflation rate. And I think there's still signs that the inflation rate is staying sticky or higher. The problem is if the Fed wants to print money from here or cut rates too aggressively, my fear is they're going to create inflation. And the result is going to be a plunge in risk markets. Inflation is a bad thing. It is a thing that impacts 100% of the population. Even Elon Musk struggles with inflation because it raises his input costs at SpaceX and Tesla. People on assistance struggle with inflation. We call it affordability. And now Trump's approval rating is declining because of the inflation problem. So we have to be very, very careful. This is not 2010 to 2022. That cycle is over. We have to be careful with this talk about liquidity. Pumping in too much liquidity could backfire if it just goes into creating inflation. Now, how could it create inflation? That gets to this concept of the K-shaped economy. The top end of income is doing well. The bottom end of income is not doing so well. And that's because, why is the bottom end so unhappy? I think it's the driving force is affordability. They can't afford stuff. The average price of stuff, being this cumulative rise of CPI since COVID, is up 25%. Everything is 25% more expensive, but they haven't gotten a 25% raise over the last 5 years. And that's why the bottom half is unhappy. The top half, say the top 10% of income. I tweeted this out the other day. Top half 10% of income owns about 90% of all equities in the United States. The top 10% of income, according to Mark Zandi at Moody's, he's their chief economist, accounts for 50% of all consumer spending, the most concentrated it's ever been. So if you want to cut rates, print money, send the stock market and crypto to the moon, and fatten the wallets of the top 10% so they could go out and empty the shelves of every Christmas present because they've got the money to do it, driving the price of everything up, what's the 90% going to think about this? It's not going to make things better. It's going to make things worse. And that's what we have to be careful of when we talk about this liquidity story, is that it's really around the inflation story. And we still have it 5 years after COVID. And it isn't going away. And cranking up the liquidity could very well make it worse.
SVM's ecosystem has been missing a high-speed, low-latency chain. Until now. Fogo delivers 40 millisecond block times, 1.3 second finality, and near zero fees, all backed by high-performance validators co-located near major exchange infrastructure. Made for traders, by traders, zero compromise. It's not theoretical. It's live, blazing fast, and ready for you to test. Head to fogo.io/start and experience the future of trading.
Yeah, indeed. This K-shaped economy is probably one of the biggest problems we're facing right now. In terms of the decision then, next week, the FOMC, if you were Fed governor, would you think that inflation is still persistently high above the target and they should not be cutting?
Yes. If I was Fed governor, and a quick word on my background, I actually did interview to be a Fed governor back in May of 2019. That was when I went to the White House. I met with National Economic Council Chairman Larry Kudlow at the time and the Assistant Chairman Andrew Olmstead, in the third floor of the West Wing to talk about being a potential Fed governor. They were flirting with the idea of putting a market person on. They eventually picked Judy Shelton and Chris Waller. Judy Shelton didn't make it through confirmation hearings, and Chris Waller did and was on the short list to be Fed chair. So if I had gotten that job back in 2019, I would be basically chaining myself to the door of the boardroom saying no one is allowed in if they want to cut rates. And of course, they would probably just knock the door down and step on my forehead and go in there and cut rates anyway. But at least I would try to get them to not cut rates. I think that we are at the neutral funds rate right now, if not a little bit below the neutral funds rate. But let me make a quick comment about next week's meeting. The most important thing to look at next week's meeting is not the economics. It's not whether they cut rates. It's not the outlook. It's the number of dissents. Normally, the Federal Reserve operates under this dictatorial type of regime where the Fed chairman gets what the Fed chairman wants. Now, you get to meet with the Fed chairman in private, tell him what you want. I'd meet with him and say, you're making a giant mistake. We don't want to be cutting rates. He would put his serious face on and go, I hear you, I understand. Thank you for your input. Now, please march into the room and vote to cut rates. And that's the way that the Fed has always worked, which with these 12-0, 11-1 votes. But now, because of this Trump attack on their independence, maybe the independence of Stephen Mnuchin, because the Fed has certain protocols which he is not following, which, by the way, I think is a good thing. He goes out and puts out blog posts explaining himself. He goes on long-form interviews to describe what he thinks is the optimal policy. I don't necessarily agree with him, but I applaud him for doing it because there's other Fed people that give one speech every 4 months and just do what the chairman tells them. But right now, it looks like we might be getting a 7-5 vote to cut rates. 5 dissents, maybe 8-4. If that happens, we get a 7-5, 8-4 vote, then all bets are off. Whatever Powell says at the next meeting doesn't matter. He's only one of 12 votes. Whatever Kevin Hassett, the perceived next Fed chairman, he's only one of 12 votes. Fed watching is going to be vote tallying. Okay, Mnuchin spoke. He's going to do this. Waller spoke. They're going to do that. Mary Daly spoke. She says this. Austin Goolsbee spoke, said that. And you just put the tallies in the different columns. Cut, hold, or hike. Add them all up. And that's where the policy is going to be. If that's a 7-5, 8-4 vote, it changes everything. If the Fed caves and there's a 10-2, 11-1 vote or something like that at next week's meeting, they all give speeches. We shouldn't cut rates. We shouldn't cut rates. And then because the chairman wants to cut rates, they go into the meeting and vote to cut rates. If they do that, then Hassett's coming in and he's going to be pushing on Trump's view that the funds rate by the end of next year should be 1%. And then I'll start to worry whether or not we're going to over ease and stimulate too much inflation. But for the short term, 7-5, 8-4, or is it going to be 11-1 or 10-2? because that's really going to tell the tale of the tape. I think it's going to probably be 7.5 to 8.4. And if it is, when Powell is speaking, remember he's 12% of the Fed. He's the 12% of the meeting now. He's not all of the meeting, and you have to view him differently at that point.
Yeah, very interesting. It's also fascinating that you interviewed to become a Fed governor. So if you had indeed chained yourself to the door at the FOMC meeting and not allowed fellow governors in, I'm sure Trump would have sent the Secret Service on you to open the doors there when the votes came in. It's really interesting.
I'll give you a little inside baseball how I got that position too, how I got the position to interview for Fed governor. Larry Kudlow's been an old friend of mine for many, many years. And when I knew that there was a Fed governor position open, I sent him an email, kind of half serious, half joking. I said, hey, I see you got a couple open spots. I'm available. And I got a response back 10 minutes later. So when can you come to the White House? It's basically what the answer was. And the reason I say that is, Rick Reeder and Mark Summerlin and David Zervos and a bunch of other people that were interviewing to be Fed chairman. How did they get the interview Fed chairman? They had two qualifications. They were friends of Scott Bessent's, and they were very dovish. I am not a friend of Scott Bessent's, and so I was not going to be on the list. The point is, you think that this is how this stuff gets picked, is you just got to know the right person at the right time. I knew the right person at the right time to get interviewed. I didn't know the right person at the right time to get the job. And the same thing with Zervos and, with Reeder and with Mark Summerlin and some of the other names that have been floated to be Fed chairman.
Yeah, right?
Yeah.
Coming back to the point you make about how politicized the Fed has become and how polarized it has become with regards to the different governors and the votes, I guess the question is then, I think that there's been an overemphasis placed then on the view of the chairman himself. But as you point out, there's many voting governors. And I guess the question is so next year, if there is a lot of dissent, do you think that there's going to be more friction with Trump when he realizes that even though he has some friendly governors and he's got a friendly chairman, the other governors may hold out, and then this basically could lead to more friction and fights with the executive branch and the Fed?
Oh, he'll lose his ever-loving mind over it. But then he'll start to realize there's not a whole lot he can do about it. He can't go in and fire all the Fed governors. Remember, the voting in the Fed, there's supposed to be 12 members when they're fully staffed, and they are right now. 7 of them are governors, and the other 5 are rotating Federal Reserve presidents. So he doesn't have the ability to fire all of them and replace all of them. So he's going to have to start to realize that he's limited, much like he's limited at the Supreme Court, to the extent that you never hear Trump or any president, I shouldn't just put this on Trump, bashing the Chief Justice. Why aren't you voting for this or voting for that? What's wrong with you, Mr. Chief Justice? Because everybody understands the Chief Justice kind of organizes the court, but he's only one of 9 votes. And maybe that's what the Federal Reserve Chairman is going to be. He organizes the Fed, but he's only one of 12 votes then at that point. And so, yeah, he'll lose his mind, but he'll be very limited in what he could do. And by the way, if we do get all those dissents, everybody likes to talk about forward guidance at the Fed. Forward guidance is the fancy word that they use for what's the Fed hinting they're going to do next. Forward guidance is going to be dissents. If it's a 7-5 vote, that means they're very close to ending. If it's an 11-1 vote, whether it's to cut, hold, or hike, that means that they're going to continue to do that. There's strong agreement to continue. So we're going to be looking at the dissent process as a way to try and gauge where we are in the cycle. By the way, that's exactly what we do when we look at the Bank of England. The Bank of England recently had a vote to cut rates, which was 4-4-1. They have 9 voters. And the one was to cut rates 50 basis points. So they wound up cutting 25, but it was a tie. But that was a signal that they were at the end of the cycle, because the vote was so divided and stuff. So that's the way we're going to look at the Fed. And Trump is going to have to start to realize that that's what the Fed is. And it's not just going to be, Kevin, do what I say. Kevin will, but he might be the first Fed chairman, if he pushes too hard, to get outvoted. I don't think there's ever been one in the 107 or 108 year history of the Fed to ever get outvoted by his own committee.
Yeah, really interesting. Let's assume then that they get the rate cut next week, and then they try and go forward next year, and then there's potential changes that people have alluded to on the fiscal side, this whole concept of fiscal dominance and bank and reserve ratios and all that. And you do have a liquidity flooding into the markets, and then it does increase the price of that, all assets, including, let's assume, crypto. But then you've alluded to the question of, in terms of what does that mean for the broader economy? Because you're only talking about the people who hold actual financial assets that are going to benefit. So, and this is the K-shaped economy again. So what are the implications of the K-shaped economy for fiscal policy, populism, and potentially future elections as well? Because next year is an election year in the US in terms of
Yeah,
the midterms.
I think it's going to be huge. But let me go back to the beginning. We're talking about more liquidity, and we're talking about that there's a squeeze of liquidity. That's why we ended QT. What does that mean in simple terms? What that means is that we have a $38 trillion bond market on its way to 40 trillion. 41 trillion is now the new debt ceiling, which will probably hit towards the end of next year or maybe into early 27. That is a huge market. Now, that market has a funding market, which is the repo market, which is the bank reserves market. And that market, that funding market, is used to finance that $38 trillion government bond market. The reason that we're seeing the tightness and the liquidity problems is those funding markets are too small relative to the size of the bond market. The bond market has grown too fast relative to the funding markets. Why are the funding markets too small? Because the Fed has been QTing, removing liquidity out of the financial system as the bond market has been mushrooming in size because of the huge deficits. And now the bond market's too big. And that's why we're seeing, funding interest rates, repo rates moving up. The way we've tried to explain it is the Fed has cut 50 basis points, but the repo rates that we all look at are really only down about 30 or 35 basis points. So it's not like the Fed has cut 50. In reality, they've more cut like 30 because of that tightness in the repo market. And the fear is that the tightness is not ending. It's not getting better. It's continuing to get a little bit worse. Now they'll cut rates again, but then we'll see that tightness in the market. Why don't we QE, put more reserves in the system so we can have these funding markets expand to meet the size of the bond market? And by the way, the way it works, I don't know how deep we want to go in this rabbit hole, but I'll say this as quickly as I can. The way it works is that most of the buyers of bonds are not unlevered buyers. Like when you and I buy crypto or we buy stocks, if I buy $1,000 worth of stocks, I write a check or I transfer $1,000 to my broker and he gives me the stock. If I am a buyer of treasury securities and I'm a hedge fund and I buy $1 billion worth of 2-year notes, I don't have $1 billion. In fact, I have no money. So where do I get the $1 billion to pay for those 2-year notes? I use them as collateral. I go to a bank. Here's $1 billion of collateral, the 2-year notes I just bought. Give me an overnight loan of $1 billion so I can pay for these bonds. And then I'll roll the loan every day. The problem you're facing is you go to the bank and they say, here's my $1 billion of collateral. And the bank says, I only can hand out so many of these repo loans because of the amount of reserves I have, because the Fed keeps reducing it. I don't have any more money to do it. Call another bank. And that's when the rates start moving up. The price of funding starts moving up. If we expand the market to allow it to get to be big enough to meet the needs of this bond market so that these rates settle down to where they're supposed to be, where they were 4 or 5 months ago, what is the signal we're sending to Washington? Those giant budget deficits and that profligate spending that you're doing, you could continue it, maybe add a little bit more. You could borrow into infinity. What is the biggest driver of inflation? Government spending. So if we expand the liquidity in the market, we're saying to the government, spend more money, get bigger, impose your will even larger on the economy, and that's inflationary. So I think we have to understand when we're talking about this liquidity problem, and we need more liquidity, what we're demanding is more government, more inflation. And that's what's different now. And that's why this funding problem needs to really be understood.
Yeah, that is the fiscal dominance, right? Like
right.
And
The problem with the fiscal dominance story in a nutshell is if you say, no, we have to do this, then all fiscal dominance ends in catastrophe. Because what you're saying is print, cut rates, print, cut rates, print, cut rates. When do you stop doing it? You never stop doing it. Why? Because fiscal dominance will never, ever go away. So when does it end? When everything blows up, because inflation becomes such a problem that the next time you print, every asset goes down in price. That was the 70s, by the way. The more you tried to accommodate, the worse things got. And so the problem with fiscal dominance is you've pulled the pin on a grenade, and now we're just arguing about when it's going to blow up. It will blow up, and so that is why if you want to go down that fiscal dominance road, this is the last trade. You better wind up rich and out of the market because it will end badly. Now, they've said that. It sounds very dark. Maybe it's 20 years from today, or maybe it's 4 months. We don't know when, But we just know you can't get off that train when you go fiscal dominance. And the only thing that gets you off that train is when markets reject it. And the reason markets reject it is because of runaway inflation.
Harks back to that saying, and nothing stops this train, and unless it goes off a cliff because of a fiscal crisis at some point. I mean, isn't that really the only end you can have in terms of the US government in totality? Because it seems like no one really cares about the fiscal situation, right?
Right. Lynn Alden, who coined the train, nothing stops this train, is absolutely right. What I'm just trying to say is I agree with her. Don't start the train. Let's just not start it in the first place, because once it goes, and she would argue, it's been going for a long time, it doesn't end well. It will never end well. But you're right. It all really comes down to, if you want to, there's another way to fix the liquidity problem, right? Is to go to Washington and say, you know why we have this liquidity problem? It's because you guys borrow too much money. You got to borrow less money. That's a complete non-starter. That's going to get nowhere in the world. They're going to just say, no, Fed print more money so we could expand our programs and we can borrow even more money and we could do even more government is where we're going to go. So yeah, that's the problem with the fiscal dominance train, is that you're saying the hell with inflation, the hell with everything else, just print. Now, again, I'll come back to, didn't we do that from 2010 to 2022? Yes. But what did we never have during that period? An inflation rate above 2%. What do we have now? An inflation rate still at 5 years after COVID. And that's why doing it again now could have a very different outcome than what we saw between 2010 and 2022.
Yeah, stock. Just going back to the markets again and asset classes, on the opposite end of the spectrum from crypto are precious metals. And they've been performing very well, especially gold and silver over this year. And you've noted previously in your research this performance as well. So I'm curious what you think in terms of the outlook for precious metals next year is.
Yeah, so we're going to get into our Lord and Savior Peter Schiff's little world, right? As far as precious metals go.
I saw on crypto Twitter, the real bottom is realizing that Peter Schiff was right.
Yeah, exactly. Maybe he should be the Fed chairman. Two things about the precious metals markets. They're very small, whereas the TradFi markets, if you talk about stocks, bonds worldwide, you're talking about $130 to $150 trillion with a T. You're talking about less than 10 trillion, maybe around 5 trillion for the precious metals markets. So they're very, very small markets, meaning it doesn't take a lot of money to move them. And where's that money coming from? It's largely coming out of Asia. You're seeing tremendous buying out of Asia in the precious metals. What you're getting in the United States and in Europe is you're just getting momentum degen buying out of that. Going back to my Greenwich Country Club example, they're not driving the price of gold, or they're not driving the price of silver. They might be playing the momentum of it. It's being basically driven by the People's Bank of China. It's being driven by some of the other Asian central banks, and it's being driven by private sector buyers in Asia. Now, the reason I said that is because it's a small market. That's all it needs. It needs one underwriter to really push it, and there is where it's going. Is it a warning sign? Is it a signal that there are problems in the world? Yeah. It definitely is. And especially coming out of Asia, that there is problems. If you look at the Chinese economy, it's a mess. It has been a mess since COVID. It's never really recovered from COVID. The rest of the Asian economies are not doing that well. And that's why you're seeing that rush into the safety of precious metals right now. Is that going to metastasize into Japan, the United States, Western Europe? Maybe it does. And if so, I think that there could be more legs to the precious metals move, again, because it's a fairly small market at this point. But it found a big buyer, and that's why it moved. Just like in 2023, another small market is crypto. Bitcoin found a big buyer in TradFi through the spot ETFs and stuff. And, it was 25,000 in June of 23, I believe. And then it went to 100,000 by early 25 or mid 25. It found its buyer within a larger TradFi universe and moved up. That's what's happening with the precious metals. That's at least my take.
That's interesting. I'm curious, though, in terms of another theory, or in what's driving gold especially, is the de-dollarization, especially by large foreign central banks, and concerns around the weaponization of the financial system against countries like Russia, for example, that leads to these central banks wanting to diversify into a precious metal like gold. Do you not think that could also be a large driver? Because I think that there's also been talk about how Chinese central bank has just been hoovering up gold over the past few months, and that's what's led to a lot of this price action.
Oh, yeah. I mean, that's definitely it. Like I said, the People's Bank of China is a big buyer, and they are trying to protect themselves from tariffs and the friction that they're having with the Trump administration. But also, the Chinese population is gigantic buyers of gold right now, might be bigger buyers than the central bank in and of itself. Is it de-dollarization? Yes, it's de-dollarization for them, but is it de-dollarization for the rest of the world? That is still an open question, whether or not we're going to see de-dollarization for the rest of the world. Let me put it to you bluntly. We're all excited about stablecoins. Well, if we're worried about de-dollarization, then stablecoins are a non-starter. But since we're all excited about stablecoins, I guess de-dollarization is not necessarily the thing. Right now, like I said, I think the biggest issue right now is the Chinese economy is weak and vulnerable. Trump is attacking it. They're protecting themselves by buying gold. I think one of the most misreported stories of 2025 has been the pain that U.S. tariffs have inflicted on China. Not the pain that they've inflicted. We get a never-ending stream of stories about the pain that it inflicts on American consumers, but we're not really appreciating the damage that it's doing to the Chinese economy. And that's why I think we're seeing the Chinese trying to protect themselves by buying things like gold and trying to push that price up. Or their buying is pushing that price up. So yeah, I definitely think it is. But I'm not ready to go to say that the entire world is ready to abandon the dollar. There needs to be a medium of exchange. If I am going to go to a Chilean mine to buy copper, I got to pay for it with something. And that something needs to be a market that trades $1 trillion a day, has trillions of dollars of derivatives so I could buy forward contracts and the like. Gold doesn't have any of that. Crypto doesn't have any of that. You got till 1 o'clock this afternoon to create that. You're not going to. It's going to take you 10 or 20 years to create it. The dollar is not going away. It is the default. We're lucky that it is the default because we're mismanaging the hell out of it, but it isn't going to go away. The Chinese are a separate story.
Yeah, it's a very interesting point you raised there. I'm curious in terms of, because the mainstream narrative tends to be, they always talk about the US consumer that's getting hurt by the tariffs. And you raise here, for example, how bad the tariffs have been for the Chinese economy. What particular points could you point to that in terms of economic data points that show this particularly?
Oh, their economic growth is terrible right now. Keep in mind that we got to put the Chinese economy in the perspective. They're growing at 4 or 5%. Now, in Western Europe or in the United States, boy, that sounds like a lot of growth. That's one of the lowest growth rates other than COVID. Take COVID out of the equation because that was a one special circumstance. 4%, 5% growth out of China is one of the worst growth levels they've seen in 50 years. They've only given us data back to the 1970s when they opened up their economy. And this is about as bad a growth rate as they've seen. Yes, it's 4, but they were used to 15, 18% growth rates, 15 years ago, 10 years ago, and now they're down around 4. So their economy is growing very slowly. Their industrial production numbers are falling off of a cliff because their trade is being greatly impacted by the United States right now. And they've also got gigantic internal problem with real estate and real estate bad loans. What they did is we all are aware of, we've all seen the pictures of those ghost cities. Well, what's happened is China did something unusual, right? They built cities for 1 million people that were uninhabited. They sold all those condos and all that property to tens of millions of Chinese people as part of their savings and investments. And no one ever populated those cities, and all that real estate is falling in value. People are defaulting on these loans because they can't sell this property. Nobody wants to buy it. It's starting to impact their banking system. They're trying to prop up their real estate, but they really can't. The way they got to prop up the real estate is they need to say 30 or 40, remember they got 1.4 billion people, 30 or 40 or 50 million of you, please move into this ghost city that we created for 1 million people and occupy that condo, work there, spend your money there, but nobody's doing that right now. And so they've got a tremendous internal real estate problem as well. And the trade deficit, the tariffs, not the trade deficit, the tariffs are making it worse because the only thing that was keeping the whole system afloat was the massive trade and the dollars that they were getting from the massive trade. Well, that's being restricted because of tariffs.
Well, great geopolitical rivals. And the question then becomes, you've alluded to now the risks of the K-shaped economy in the US and potential social strife around inequality. But then there's also the risks in China now around the ghost cities and the sluggish economy. Who do you think going into next year or the next 2 years, are we likely to see more internal social strife between China and the US?
I think, though, we'll try to not have it, but ultimately, I think that we are going to see more internal strife. Everything that comes out of China is state sponsored. China has agreed with the United States to stop the fentanyl flow. They've agreed. It better stop. Otherwise, it's going to anger Trump and he's going to ratchet up the pressure on them. China's also they're definitely afraid of internal strife in China. Do not discount what happened in late 23. Remember, they were under zero COVID. Just to remind everybody what happened in late 23. They were under zero COVID. Let's make sure everybody understands what zero COVID meant. Zero COVID meant you weren't allowed to leave your apartment. Everybody lives in an apartment in China. And to make sure you weren't allowed to leave your apartment, they welded the door shut of the apartment. So you were stuck in the building. How were you supposed to get food? Government officials sent you bags of food and you lowered a rope down and you pulled the bag of food up. And they were doing a bad job of it. They weren't sending enough food. They were sending rancid food. Then there was a fire. There was a fire in one of the buildings and the fire brigade didn't make it on time. And the people were banging on that welded door shut to get out. And a lot of people burned up and died. And what happened was it sparked what was called the white paper revolution in November of 23. And everybody really pushed back on this whole idea of zero COVID being welded into their apartment. And the government, like that, folded. Zero COVID is over, effective immediately, showing their weakness that when the people in China push back, they have no ability to stop them. And they're angry. And they got that pushback from COVID. So there is a lot of strife in China right now. We just don't report on it in the West because we'd rather talk about how Trump is mean and orange and terrible. That's the story we want to report on. Maybe that's true or maybe that's not true. But two things can be true at the same time. There's also a lot of strife in China too. And we just don't report on it. But it's there and it exists. What fixes it is 10, 12, 15% growth in China like they had a dozen years ago. But they have 4 or 5 right now. So it's not going to get better.
White paper revolution, you say?
Yes.
What was that in relation to? Is that the white papers?
Well, what happened was that everybody held up a piece of white paper when they were protesting. They held up a piece of white paper to basically say that this is their anger. I forgot why they did it, to be honest with you, but it was a metaphor for the zero COVID, the rules and the regulations that we didn't understand. So we held up a piece of white paper, and that's why it got dubbed the white paper revolution back in November. It didn't last for very long, but it did. Also, there was another incident too. There was an incident at Foxconn factory where they made iPhones, and this made Apple very uncomfortable, right? That the white paper revolution really pushed back, and some of the workers were creating a slowdown in one of the Apple factories to make iPhones. And Apple was afraid that they were not going to meet their production requirements. And so the police were sent in and they beat the crap out of all of the protesters on the floor of the Foxconn plant, where they said, stop doing this, get back to assembling iPhones. And it put Tim Cook in an unbelievably uncomfortable position at the time, which by early 24, he said that they're going to now start producing iPhones in India and not produce iPhones in China. But the whole fact of the matter was that it was also another eye-opening thing. See, you're just a cog in the system here. Go to work, screw this screw into an iPhone for 8 hours a day, get paid pittances. And if you so much as asked to go to the bathroom too much, somebody with a billy club is going to come over here and teach you that you're not allowed to do that. And that's why you had that pushback against the people, at the Foxconn factory. And so there's a lot of strife. I mean, yes, I am a big China bear. I mean, if you haven't figured it out by now, but there is a lot of problems in China. And just because the New York Times didn't write about the problems today or yesterday doesn't mean they don't exist.
It's quite interesting, the coincidence that what signifies freedom in China is a white paper, and similarly to the Bitcoin white paper, financial freedom as well. So quite some parallels there. Just to finish off, Jim, with a few more lighthearted questions then. I'm curious to get your take then. First and most important, let's start with, if you're okay with this, price predictions. I don't know if you
Sure.
feel comfortable with that, but maybe
depends
a Bitcoin
on which
price
one.
prediction. Bitcoin, because we are a crypto native publication. Maybe Bitcoin 1 year from now, December 3rd, 2026. Where do you think we could be? Based on all available information, your view of how things could play out.
MicroStrategy's break even or average cost on the Bitcoin it owns is 74K. The average cost is 90K on all of the spot Bitcoin ETFs. I think we got to go below 74K first, maybe down, under 70. And I think that maybe by the end, 1 year from today, December of 26, we're on our way back up. But it's going to be very, very painful first, especially when we get under 74. The issue is if we're on our way back up, look, we could be at 85 in a year, or we could be at 110 or 120 in a year. The issue is going to be how much damage is that going to do to the TradFi buyer? MicroStrategies and all the Bitcoin ETFs own 10% of the circulating supply. If you damage their psyche, it could be a while before we see rallies going. But I think we're going to go down first, and maybe by a year from now, we'll be on the backside of that. And ask me how much damage we've done on the psyche. If we did a little bit, it'll go much higher. If we did a lot, it might only be recovering to the mid 80s by then. I'll try and be shorter on these.
No, it's all good. No, it's fair. It's okay. So we see. So following the 4-year cycle, we've had a crash, and then we potentially recover, but depends on what happens in terms of the psyche and the sentiment.
Speaking of the 4-year cycle, I got a question for you. The halving didn't work, or do you disagree? The last halving really didn't work as far as being if we have too much now that the incremental is just too small for it to matter?
I think it's kind of like it's this ceremony that kind of like Christmas that crypto bros have around the halving, but it's also coincided with liquidity cycles in general, the business cycle. And I think it's just been a coincidence that it's happened around the halving itself. And also there's the self-reinforcing mechanism where people will buy Bitcoin because they think the halving has an impact. But if you look at it from the perspective of inflation rates, it's minuscule now.
That's my argument too, is that when the inflation rate went from 10 to 5 or 5 to 2.5, you could say that was meaningful. But now that you've had so many halvings, the incremental change in the inflation rate is so small, it doesn't really mean anything.
Minuscule, yeah. And then finally, Jim, you obviously have someone with a lot of strong opinions on Twitter or X. And I had a question for you personally. How do you sometimes handle the trolls?
I do two things with trolls. I don't block any trolls. The only people I block are scammers. And B, I usually like them. If you're going to troll me, I will usually say, if you're creative, if you make me laugh, I'll give you a like. But largely, I ignore them. I like to say, as far as the trolls go, I told somebody else that somebody asked me about the trolls. I said, "What do you do about the trolls?" I said, "Don't worry, they'll get over it over time." There's a couple of my favorite trolls that usually have very biting and inflammatory remarks about me that I'll give them a like if they're particularly creative.
I love that. Yeah, take nothing personal, like water off a duck's back. Great advice, man.
Also, at the end of the day, I would also just, whenever I look at some of the trolls and and they get very, very vicious, just so people understand, I'm not trying to brag. I have over 500,000 followers on Twitter. And somebody gets very, very vicious, and it's like way down on the reply threads. And I go, man, that is really a low blow. And then I look at it and go, like, yeah, it's got like 182 views, so it's like, let it go. It doesn't matter.
Make his day, Jim, and just interact with him. I'm sure it will make his whole week to get a response.
I do. Like I said, if they're creative or if they bring up an interesting point, I do interact with them from that at time to time.
Well, thanks, Jim. I really enjoyed this and appreciate you coming on. I'll leave a link to your Twitter, speaking of which, down below in the description. But where else can people follow you?
Aren't we supposed to call it X now? Aren't we supposed to call it X? Or do we still call it Twitter?
Freudian slip, I'm sorry. X. I'll leave a link to your X down below. Is there anywhere else where people can follow your work, your website?
Yeah, so it's Bianco Research. That's the name of my research company. On Twitter, Bianco Research on LinkedIn. Bianco Research, we have a YouTube channel. We also have a separate, that's our research business, which everybody knows me by. We also manage an index, a fixed income index, because I'm a bond guy at heart, the Bianco Research Total Return Index. You could find out about that at biancoadvisors.com. And there's an ETF that tracks our index, WTBN. Wisdom Tree is our partner. Wisdom Tree, Bianco Nancy, WTBN. And you can find out more about it at Bianco Advisors too. So you could check that out if you're interested in the bond market.
Check it out, guys. We'll leave it down below. Thanks again for coming on, Jim. Hopefully we do this one time again soon. Appreciate it.
Sure. Enjoyed it.